Good morning, everyone. I hope you can hear me and you can see my screen. Yeah, you can just quickly react with a thumbs up if you're able to connect with audio as well as see the screen. Great. Okay. So then we can go ahead and start the webinar. So first of all, thank you to everyone who's joining us today. We wanted to do a webinar on good investing in bad times because there has been a sentiment shift in the markets over the last couple of weeks. You've seen the Nifty correct almost 2%. You've had 6 consecutive trading sessions where the Nifty has ended lower. This is quite different from the context that most of us have been used to in the last 4 to 5 years in the market. So, this is also something as strategists that we've been cognizant of that it can happen at any point. And so I think it's very natural for an investor also today to wonder whether they're doing the right things in their portfolio, whether they need to change something, whether they need to prepare for what is coming next. And I think initially there was an expectation that, okay, it'll get contained within the Nifty. And then now you're seeing that it's spreading even to like the small and mid cap spaces. You're seeing that portfolios are actually correcting at a deeper level than the broader indices as well. So when all of this is happening, I think investors tend to come back to the drawing board and see what they're doing. So what does it mean to actually practice good investing, and what does it actually mean to be in good or bad times? These are some of the things that we're going to explore in today's webinar, and our structure and format is going to be pretty simple. I'll walk you through the presentation. We'll have enough time towards the end in terms of taking Q&A. So anything that you have, as and when you have a question, please type it into the chat box and then, sorry, is my audio not clear? Is this better? Okay. So maybe whoever's facing some audio issues, can you please check your individual settings, and I'll just go ahead, right? So Q&A we can take towards the end. Please feel free to share whatever thoughts you have, and then we can move on. So this is a symbol that all of us are actually familiar with. It's the idea of yin and yang, and it represents balance as well as good and bad going together at any point in time, right? So in the good, you have a little bit of bad. In the bad, you have a little bit of good. And the structure of yin yang is basically to show that balance between the two elements. So when we think about investing and what is good versus what is bad, I think the good that we look forward to is really the returns, and the bad or the things that we have to deal with are essentially risk. So when we look at this risk return relationship, I think what we notice is that the very simplified version of that is that the more risk you take, the better your returns are going to be. But that actually is a very misleading structure of how risk and reward are actually related. Because even if you look at the safest investment, right, it has some elements of risk. If we take, for example, a bank FD, where you're definitely not going to lose any money, right? You know that you have a fixed rate of return. You know that banks are very well regulated. The RBI has protected your interest as a deposit holder. Even in that scenario, there is a certain risk that you take, which is that over a period of time, you might lose value to inflation, right? Which means that you do have to look at taking something else to compensate for that. So similarly, when we enter into equity markets, the risk is known that returns are not guaranteed, returns are non-linear, returns can be very lumpy. So investors need to mentally prepare for a product that gives you that kind of return profile, which means that you can't expect the same return year on year. You're going to have good years, you're going to have bad years, you're going to have forgettable years as investors, right? So this is where that element of speculation and that balance between risk and reward is what investors really need to focus on when they're looking at creating long-term wealth. So now I'll talk about why people feel like this is the best of times. And if we look at what is contributing to the best of times, we'll notice that the India story has been quite strong through the COVID years. So we actually had a dip in 2019 where our economy was slowing down. You had a slowdown in the auto sector. You had this sort of banking crisis blow up. Banks were slowing down, public sector banks needed recapitalization. So India was not actually in such a great place pre-COVID. But in the post-COVID era, a lot of the reforms and structuring that happened in the years leading up to that actually ended up playing out really well. So if we look at today's India story, there's a lot on financial inclusion, which has basically come in through your JAM Trinity, that is your Jan Dhan, your Aadhaar, and your mobile. So people have bank accounts, people are able to move into the formal economy through these digital payment systems. You're also having this great demographic dividend. So when we look at global counterparts, you're seeing a lot of slowdown in advanced economies, primarily because their workforce is actually shrinking over a period of time. Whereas India does not actually have that problem, because we have a lot of people who are young, who are going to enter the workforce for a sustained period of 20, 30 years, right? So this is, again, a big blessing in terms of where our growth is heading. Over and above this, I think the thing that has really impressed global counterparts is our digital stack, whether it's in terms of payments, whether it's in terms of social security, whether it's in terms of direct benefit transfer. All of these things have actually come out of digital infrastructure, and that has been pretty strong and profound in terms of how far it's been able to impact the Indian economy. And of course, some slightly older policy structures. You have the Make in India scheme, which has allowed for more manufacturing. And you're seeing, let's say, if you're tracking something like the iPhone, about a third of iPhones are going to be manufactured out of India, right? So our market share in a lot of these contexts is actually growing. And then you have the production linked incentive scheme, again, a boost towards manufacturing. Manufacturing has actually been one of those engines which can contribute a lot to our economy and is only now picking up in terms of its share. So the India story is very positive. There are a lot of drivers. You're definitely seeing higher levels of growth in India compared to most global counterparts. We are projected to have a 7% plus growth in the coming year. And this has been 3-4 years where we've been performing really well. So I think from a broad perspective, everyone is looking at India as an exception to what is happening globally, because globally you're still talking about recession, you're still talking about uncertainty, you're talking about slowdowns. Many central banks are unwinding a lot of the policy that they've sort of held loose for a very long time. So all of those consequences are coming back to the table. And at the same time, it's not just about, broad economy, macros, or even equity markets. I think even on the fixed income side, India is actually doing quite well, because you have, there's a really good article from the World Bank where they talked about India's bond with the world, where last year you had India's bonds getting included into the JP Morgan index with a weight of 10%, where from January to October, they've been sort of putting in 1% every month. And that has led to a flow of $20 to $25 billion on Indian bonds. Similarly, Bloomberg is scheduled to do another inclusion in next year, that is in a few months. And again, this will be a 1 to 10% weight, but not as large in size. And similarly, you have something from FTSE as well. So there is a demand for Indian bonds. You are seeing some level of movement in terms of how India's macros are structured, what our rating looks like. And if we continue to maintain a good macroeconomic structure, as well as we continue on this path of fiscal consolidation, then we're very likely to get a rating upgrade also from global rating agencies. And that could, in fact, actually create more demand. Right. And in this context where you've had the Russia-Ukraine war, Russia is not a favorable country in terms of foreign investments. You've had some fear about how China is recovering. So again, India has become like this alternate to the other emerging markets that are available on these indices. So if we look at where we are in terms of monetary policy, right, we are in a sweet spot as far as investors are concerned. So one thing we'll notice is that our inflation print came out higher than expected, or rather higher than the threshold of 4 to 6%, right, or 2 to 6% rather, because the last print came out at 6.2%. But essentially, this was somewhat expected and anticipated by the RBI, because they did talk about the lower base effect that is going to come into play, which would show higher inflation readings in the coming months. And it's been pretty clear that the RBI is still focused on inflation because growth is already a given for us at this point. And inflation can spiral into a much bigger problem when growth is not there, right? And you don't know which of those is going to go away first. Ideally, you would like it to be inflation, which is why so much focus is going into managing inflation really well. So if we look at RBI commentary, it's very unlikely that December will warrant a rate cut, no matter what other advanced economies are actually doing. Primarily because for us, we're in that sweet spot of higher growth and higher inflation, which can still be managed. It's not out of the normal variation, right? So when we look at this, it's unlikely that December will have a rate cut, which means for fixed income investors, there are still good opportunities for you to lock into fixed income or move that asset allocation towards something that is steadier and more predictable in terms of income and portfolio growth. And if we look at India becoming a heavyweight in contribution to global market cap, this data is from June this year. But if you look at our historic average, it's been below 3%. And where we are today is about 4%, right? So that's a significant jump. And it could indicate a new normal as well, because you're seeing a lot of interest in Indian equities, both from domestic as well as foreign investors. Yes, there has been some pullout in terms of what's happened in the last couple of weeks. You have seen that post-US election, the dollar has strengthened, FII flows have shifted more towards the US, out of emerging markets, China and India alike. But if we look at in terms of growth potential, you have India as one of the top growing emerging economies. So likely that attention to India will continue to grow, right? The basic question is about valuations, and we'll get to that in a bit later in today's presentation. And this is something we've taken from the In Gold We Trust report. And it basically shows us that from an asset allocation perspective, you're actually expecting gold to go up significantly by 2030. Right? And this is a probability weighted sort of structure where the expectation is that today where gold is at around $2,500, $2,600, but the expectation is by 2030 it could be in the 3,000 to 4,000 range as well. There's a almost 20% chance that will be there, and a 20% chance that will be higher, right? So when we know that as investors, there are plenty of opportunities. So one, India from an economic perspective and a growth perspective has a lot to offer. Two, India has a lot to offer even on the bond market side, both from a cyclical perspective of where interest rates are today, as well as from a structural perspective as to how our economy is actually improving and our fundamentals are improving. And third, like even if you look at more safer asset classes like precious metals, even there is potential for higher growth and value creation. So now let's get on to the tough side, which is, right, are we at the worst of times? And there are some things that we need to look at. So one thing that I would really like to spend a little bit of time on, and this data is from Spark Capital, is that we're trending into shallow waters, and there is really a shrinking pool of opportunities. So if we talk to investors today and we try to understand where is it that there's comfort both in terms of earnings as well as valuations, I think the one sector that is a consensus call across all investment houses and styles is really the private bank space. So that is something where people feel there is undervaluation. There's also enough visibility in terms of how growth is going to happen and earnings will come back. Right. Whereas if we look at the other spaces, whether it's pharma, whether it's defensives, whether it's chemicals or auto, you're seeing a lot of pain points on the earnings front. Right. There is a big question mark in terms of whether these companies will actually be able to sustain the levels of growth that they've had in the last few or many quarters. And there is a question of beating these estimates, because at one level, the expectations are set very high. At the second level, you're also cyclically turning into a slower phase of growth. So while investors have been a little forgiving in terms of companies missing estimates, that's not something that can actually sustain quarter on quarter for multiple quarters, right? So at some point, you will have investors shift out of these themes into themes where they find more value or more growth potential. And if you look at spaces where you have low valuation and low earnings comfort, I think that is something where, again, a lot of money is sort of cautious of putting flows into these areas, because there's a big question mark in terms of whether these companies can actually grow. There's a bigger question mark in terms of whether these companies can actually are fairly valued even today. Right. So there is literally just one bright spot in the market. So investors need to be very cautious about how they're positioning their portfolios and what kind of risks could actually show up. So if you're seeing the markets trend downwards, we need to know that when we're looking at companies that have some level of earnings comfort, but not that much valuation comfort, there is a chance that you might have a time correction in that portfolio. There is a chance that you might see some companies getting re-rated. And wherever you don't have either of this, right, either earnings or valuation comfort, then it's primarily driven by momentum and sentiment, and you are going to have to deal with the consequences of that kind of investment performance. So there is an urgent need for investors to actually come back and look at their portfolios in a more detailed and contextual manner and try to understand what is actually going on and where are the risks that an investor has to focus on. So another interesting data point that I wanted to decode from AMFI is that every month they publish data on the flows that go into mutual funds. And when we look at this month's flows, the headlines are quite catchy, because you see that your SIP has hit 25,000 crores. And this is the biggest number for the last, I think, almost 1.5 years. You've had a pretty much one-way trajectory in terms of the SIP book growing month on month, right? So this should ideally give us a lot of comfort and give us a sense that we are in the right direction. People are putting money, like you have people who are regularly saving money in the markets, right? This is not one-off money. This is not hot money from FIIs that could come and go at any point. This is sticky money. But when we look at how sticky that money is, what we'll realize is it's really not that sticky, because your SIP, the new SIPs that are getting registered are actually slowing down, right? And the number of SIPs that are getting discontinued, or where you have SIP stoppage, essentially, either because that SIP period is over or because investors are stopping and switching to other funds, has actually shot up. And these two are actually trends that are a little bit worrying, because it shows that investors are not sticking to their original plan or their original timelines, and they're not being patient with their investments. So if the SIP number overall grows, but you're not registering more numbers and you're switching your SIPs quite frequently, then that is actually leading to wealth destruction, right? And that could again make the level of confidence in terms of where investors are kind of trend lower and lower until a point where you'll actually see that in the market as well, because flows will follow how sentiment works. So these were two data points that I wanted to take you through. And now we'll do a bunch of quick polls, right? I'd like us to follow the money and try to understand what is actually happening in the markets today. So feel free for each of the polls, just feel free to type in the alphabet that you think is the right answer. Okay, so we looked at data from Amphi between 2019 December and October 2024. And how much do you think that the sectoral and thematic funds, right? How much, like how many times did that AUM actually grow in this time frame? So do you think that AUM doubled in the last 5 odd years? Do you think it's gone up 5 times? Do you think it's gone up 7 times? Or do you think it's gone up 10 times? Okay, so we have one guess for 10 times, one guess for 7 times. Any other guesses coming in? All right. So let's take a quick look at how that's doing. So a lot of people for 10 times, few for 5, few for 7. Okay. Now, I'm just gonna quickly look at these answers. And the answer to the first question is actually that it is 7 times. So the answer is that sectoral and thematic funds have actually grown 7 times since 2019 to 2024. And the reason behind this is that thematic and sectoral funds have good past performance track records, right? And if you as an investor are paying attention to what kind of NFOs are getting launched, where investors are actually participating more, what is happening, then you'd notice that basically money is flowing into sectoral and thematic funds because there's a lot of aggressive marketing that's happening on that side. At the same time, investors are also seeking some validation in terms of performance before they put their money into a particular scheme, right? So these NFOs have been able to gather a lot of AUM primarily because you're seeing some level of past performance. So if you looked at how investors flows have moved, right? Defense, infrastructure, these have all been themes where based on budget announcements, news, etc., investors have poured in a lot of money, whether it's PSU, defense, infrastructure. These three themes have been pretty hot favorites, right? At the same time, you've also had a lot of money go into small and mid cap, again with a performance bias. So this is the second, this is the first poll, and now I have also created the second poll, and you can let me move this slide as well so you can see what it is. So the question here is, in terms of, let's say, you have your entire mutual fund flows, how much do you think sectoral and thematic funds actually contributed to this? Right? So do you think it was in terms of how much of that pie belongs to sectoral and thematic funds? Do you think it's about 20%, 30%, 40%, or maybe half of the MF flows for this year are actually from mutual fund flows? Sorry, from sectoral and thematic funds. So here, I think you can just type on one of the options. Please ignore the fifth option of not great at all. Okay. So let's quickly take a look at these poll results. We've got only about 6 people participating. Anybody who has an opinion, please take a minute and contribute to the poll. You can directly vote by clicking on the button here. All right, so I've got a good number of responses, and I think there's a big bias towards 20%, and we have some a big bias towards 40%, which is almost the right answer. It's about 30%, and a lot of people have guessed 20% as well. But broadly, about 1/3 of flows have actually come in from sectoral and thematic funds, primarily through the NFO route. So I think last month, around 3,500 crores came in through NFO. So a lot of AMCs are launching newer products. Yes, there is a demand from the market as well, where investors want something newer, they want something more niche. And when we look at that, we also have to understand that overall, sectoral and thematic funds are riskier than the regular, broader, like say a flexi cap fund. And why do we say that? When you're looking at a sector or a theme, right, the risks are more concentrated. So for example, let's say I look at a sector like pharma. Now, all companies are subject to the same kind of regulatory environment. So if one company starts getting FDA notices, it's very likely that the whole lot are going to get those notices, and the sentiment for the overall sector is going to change. So again, if demand changes in a particular way, if demand slows down, let's say you're looking at auto, if demand slows down in that segment, then that's going to affect all the players. It may not affect all players in the same manner, but it's definitely going to have an overall effect on that particular company. Whereas if you look at a more like a flexi cap fund, you have multiple sectors, the same risks don't apply to all of them, right? So there is a need to have some portfolio diversity and some understanding of the cycle, because when we understand the cycle, we are better positioned to deal with the risks that are there. So sectoral and thematic funds are actually cyclical investments, and they should form part of that segment in your portfolio. They should not actually be in the core segment where you can buy and hold forever. There is a need to look at entries and exits based on the cycle. Many investors don't seem to understand this when they're looking at sectoral funds. They are just looking at 1 year, 3 year, 5 year track records and then making a decision based on performance. But this doesn't work with a sectoral fund. It may work in something that's more of a flexi cap, where you're ideally just testing to see if the fund manager has been able to manage flows and the cycle effectively. Here, your risks are going to be concentrated in certain parts, and your returns are going to be concentrated in other parts, right? So moving on to our last poll. Again, let me quickly launch this and share my screen. Here we just want to understand, okay, so we've talked a lot about sectoral and thematic funds. So now let's talk about where are investments flowing outside of these two themes? Like, what is the biggest area that's able to command investor attention, right? Is it small cap? Is it passive, or is it multi-asset and dynamic asset allocation funds? Okay. I'd request everyone to sort of just vote directly in the poll. That way we're able to see how the vote is split. Let's just give it one more minute. About 12 of you have voted, but maybe we can just wait for. Okay. I don't really see newer votes coming in, but if I take into consideration what's in the chat, then I think we have about 6 people for small cap, 3 people for passive, and 6 people for multi cap, right? Which means 15, about 20% think that passive is the scheme, whereas most of you are split between your multi-asset and small cap. And interestingly, the correct answer is actually passive. People are looking at more index options in the market context, and they're not actually looking at small cap as much as they were last year, or even multi-asset as much as they were last year, right? So if we look at how flows and NFOs were happening in 2023, there was a lot of traction towards multi-asset and dynamic asset allocation funds. AMCs were launching many of them. Investors also realized that, there are benefits of low correlation in terms of how their investing works. And small cap, of course, has been a favorite, primarily driven by a stellar track record in the last few years. And now, if you look at it, the small cap flows are actually moving more towards index, right? And not actually towards active managed funds. Now, the risk with passive investing and index-based investing is that it doesn't offer a lot of flexibility. It doesn't allow investors to respond to changing contexts. And index investing can actually complement your whole portfolio, but it cannot be your whole portfolio, right? If you are going to do index investing as your entire portfolio, then you need to have a very contrarian strategy. So it's an interesting way, but it's definitely not the way that the US looks at index investing, which is buy and forget about it, right? That kind of investing doesn't really work in our economic and financial market context. So now coming on to how things are, I feel like the way investors are approaching these changing times are that they think that maybe if the market is falling, they should start pausing their investments, right? So this could be in terms of pausing your SIPs, holding back, like if you're a portfolio PMS investor, holding back on contributing to your portfolio management service product. It could be in terms of just waiting, right, on cash waiting for the market to correct more to a certain level. And then when it gets there, again, we kick the can down the road. So there has to be a certain level of discipline in pausing. If you want to pause, you want to take a breather, you want to hold cash, it's not a bad decision, but at the same time, you need to be very clear about your re-entry strategy, because this is where investors tend to miss out. Because if they're not clear about when they're going to re-enter, when they're going to participate, then the participation only comes when there's proof, which means you missed out on the best part of the rally, and your risk reward, your yin and yang is going to change, right? You're taking on more risk than you actually need. The next thing, of course, is in terms of NFOs and IPOs, where people are looking for new flavors. They are looking for some assurance in terms of performance. They're not interested in lower returns. They're more ambitious in terms of what they want to achieve. But at the same time, there isn't enough risk that's being paid. There isn't enough attention that's being paid to the risks that an investor is taking in these ideas. So that's the second thought process that we need to reflect on and work with. And the third is that investors are actually avoiding safer asset classes in a context where the safe asset classes offer a lot of risk reward value to the investor, right? So there's always an argument against investments like fixed income because there are no tax benefits associated with it. There are arguments against safe havens like precious metals because it feels like now if you're reading the papers every day, they're talking about how Bitcoin has gone up, how the dollar has gone up. But there's a very different elemental association in terms of what gold and silver can actually bring to your portfolio. So there is a need for us to look beyond what is always in front of us and what is always being pushed at us into asset classes that can actually work in a more harmonious manner for us. Which brings us to the all-important question of what is actually good investing, right? And when we think about it, we need to think about what good investing means. And this is something that I think is true, which is what is true of men is basically true of markets. Because when you have hard times, that creates strong men, and strong men create good times, and good times create weak men, and weak men create hard times, right? And I could just replace men with markets in this context. And when we look at that, if you have a difficult time in the market, you actually create strong investors. And when you have strong investors, they create good times in the market, and good times in the market create weak investors, and weak investors create hard times, right? And as this transition is happening, we've had a stellar phase in the market and we're heading into slightly more turbulent times. If we want to create wealth, we actually have to practice a better style of investing that focuses more on risk management, that focuses more on quality management, that has a longer term orientation, and that works in a more consistent manner, right? Many of us are not equipped to deal with the kind of volatility we think that we're capable of dealing with. And an interesting way to measure this is, I would recommend all of you go back home and do a risk profile test today, right? And then do this every quarter and look at whether the market has been volatile, supportive, whatever it has been, and see if your psychology or your behavior is actually changing through these phases. When you do this on a more consistent basis, you will observe that the level of risk that you think you can take versus the level of risk that you actually take are not always the same. And coming on to what we think is good investing, I think good investing is something that gives you consistent returns. It's something that has smaller drawdowns, which means you don't see these peaks and troughs as very sharp movements in your journey. It's also something where you feel that investing is actually quite peaceful. You're able to sleep well at night. You're able to feel confident about achieving your goals. And you have a very solid process that you're following. It's not a random haphazard way of investing, which is to say that you don't decide that, okay, today I have money, let me put it somewhere. Or so-and-so told me that this investment looks good and let me invest there because I trust them. It's more about knowing that, okay, on a monthly basis, I'm going to do this much. When the market corrects, I'm going to put in this lump sum into the into my portfolio. Working with a financial plan. So having a more goal-oriented structure to your investments, meaning that you don't compromise on the goal, right? You have your eye on the prize and you work towards it. And lastly, investing should be stress-free, right? Yes, the market is going to go up and down, but if you're working with somebody who's able to communicate that to you and prepare you for those movements, then automatically you're not in for very nasty surprises. And that I think is very, very important and crucial. So how do we get to good investing? I think there's a lot of wisdom that we can take on. This is from John Neff, and he says that it's not always easy to do what's unpopular, but that's basically how you make money. And the key idea here is that you want to be a contrarian investor, right? You want to buy when people are being a little bit fearful of what's happening in the market. You want to look at investors. You want to look at overall sentiment and see whether investors are pricing in everything or not. And you want to look at buying on the cannons and selling on the trumpets, which basically means at the bottoms, you want to participate more. So as the market weakens, I think the opportunity for you to participate actually improves. So building that war chest and that liquidity is crucial today, right? And you want to restructure when the markets are at a stronger point. So today where we are, you can clearly see that we are in a transition phase. We've not yet transitioned into a weak or a strong or out of a strong market, but you are looking at a phase where there is a lot of opportunity to actually restructure and rework your investment strategies. And again, another interesting thing from Michael Steinhardt. Here, again, if you talk to a lot of investors, they're not at all interested in fixed income today, right? But what will happen is if you have few more weak quarters in the market, definitely investors are going to move towards something that's more predictable. But we need to play a more contrarian game, and we need to focus on safety today and returns at some point in the future, right? The idea is that if it's not enough to just say that, okay, I have an FD or I bought a bond today. You have to do it in the right allocation, right? It has to have a meaningful weight in your portfolio, and otherwise it's not going to have a meaningful impact. It's just going to be an optical return that you see. And this is something that we love. Value investing actually never goes out of style, because the idea is very simple, right? If I have something that's worth 100 rupees, I'm able to buy it at 95, then how will I not make money off of that? But if I have something that's worth 100 rupees and I'm going to pay more for it, then there's a very good chance that I may not be able to sell it above the price that I bought it at. So it's in a way a very timeless method of wealth creation. And I think the biggest and the greatest investors also advocate for value investing. So again, from Seth Klarman, he says that value investing is the only reliable North Star, right? Which means that what we actually need to succeed as value investors is not fancy models or anything of that sort, but it's the ability to be patient, to have a long-term orientation, and to actually be risk averse. Investors who avoid risks are likely to make better returns than investors who take on risks. And that's the interesting risk-reward relationship that we want to flip around. And finally, we'll get to how this is part of the solution, right? When you have value and contrarian investing, you get better or more consistent returns, primarily because you are investing in the worst phases and you're reaping benefits as the times improve. And then we get on to multi-asset investing, where you see that diversification is not just a survival strategy, right? It is an aggressive strategy because you never know where the next windfall will come from. And that's an important thing, because a lot of us think that today equities, given their past track record, are going to be the wealth creation engines for us. But it's very likely that the wealth creation engine is going to be something else. And we will only know that in the future. And when we are multi-asset investors in a very serious manner, that is with decent position sizing, it's very likely that we are going to be able to participate in tomorrow's winners as well. So when we look at low correlation, that is, if you have 3, 4 assets in your portfolio and they're not all moving in the same direction at the same time, then your returns tend to be more consistent because you always have one engine which is running the portfolio. You also tend to have smaller drawdowns because there's always something that's moving up, something that's moving down, and those net effects get balanced out quite nicely. And you have a process towards investing. You are focusing on, how to position certain ideas, how to structure certain ideas. So then you're also winning on that side. And the result is basically stress-free investing. So there is a lot of merit in looking at diversification. And this is data from Bandhan AMC, where they show you what is the correlation between different asset classes, right? And if you have correlations that are low, that is, let's say, closer to zero, and if you have correlations that are negative between assets in a portfolio, then those portfolios tend to do much better because in all scenarios, they are more well-rounded and more wholesome. So moving on, I'd like to take you through Sphere and where the magic happens for us. Sphere is our multi-asset PMS for residential investors. So if we look at in terms of drawdown, Sphere our maximum drawdown since inception has been around 11%. The multi-asset index at that point fell 8%, whereas your Nifty fell around 16%. So if you look at this in terms of how the drawdown has been structured, we are at a better position than a pure equity index like the Nifty. And we are slightly worse than, say, a multi-asset passive index. When we look at our overall concentration, our concentration is more towards equities because that's how the cycle has worked out. And this is just a comparison of how we've been doing against peers. And you can see that this first line, the tall one, is where Sphere is. And outside of our 1-month performance, we've basically outdone all of our peers, whether they're on the pure equity side, whether it's on a multi-asset fund or a category or even the best fund in the industry, right? And this is our performance as of October as well. So you can see that October has been a pretty rocky month, but we've not done worse than the multi-asset index. We've actually been slightly better. Over time, if you've been coming to our webinars, you would have noticed that we were 70-75% in equity at the start of the year, and you've seen that nice shift that's happened. And this is what we've been trying to tell investors as well. Over a period of time, as the opportunities and the context changes, the asset allocation of the fund will also change. Newer investors obviously have higher allocation towards non-equity investments. And with that, I'll just walk you through the terms of investment. Sphere is a SEBI-registered PMS. So our minimum investment ticket size is 50 lakhs by regulatory guidelines. We have structured this fund to have no exit load. So anybody who wants to invest can exit at any point without any additional charges. Our fee structure also is fairly straightforward and investor friendly with a 1.5% per annum structure, excluding GST, and you'll have certain other expenses as well. This product suits investors with a longer investment horizon. It works well for your retirement corpus. It works well for general wealth creation. It works well for creating a legacy as well. We have a very flexible mandate in terms of being able to participate across the board, whether it's in products in terms of stocks, mutual funds, or ETFs, or if it's in terms of assets like equities, precious metals, debt, all of this, right? So this is a little bit about Sphere, and this is our entire team. We have a lot of people working on our PMS products. We totally have 5 products in-house. So we have Solitaire, our flagship multi flexi cap fund. We have True Blue, which is a pure blue chip portfolio. You have Briddhi small and mid cap, and Sphere and Neo are our multi asset funds for uh, resident Indians and non-resident Indians respectively. So with that, let me open up for questions. I Please feel free to type in anything that you have in the chat box, and we can have a conversation about this. If you'd like to know more about what we do, you can always reach out to us. Okay, very interesting question. Yin Yang, in this planet, every action has a reaction and then consequences. An investor must be ready to face the consequences of both good or bad to his actions. Is it better to be balanced than being rigid and rebalance from time to time? Yes, I think our view is that you need to have that flexibility, which means it's better to have the ability to rebalance from time to time, because there is no, we don't believe that there is a formula, right? And let me give you a more, let me elaborate on that a little bit more. So in the US, there was a very popular asset allocation strategy called the 60-40 portfolio, which meant that investors can invest 60% in equities, 40% in bonds, and pretty much in every market context, that portfolio does well, both in terms of returns as well as risk. That actually broke down in the last few years, right? Because you've now reached a point in the market cycle where your equities are doing exceptionally well. Your fixed income is actually not doing so great. Your inflation is really high. So overall, your that 40% that you had in fixed income is not actually beating inflation for you. And then you've had other asset classes, right? Like so in the US context, that could include things like Bitcoin and cryptocurrency, or it can also include more traditional asset classes like gold and silver and commodities, which tended to do really well in high inflation periods. So there is a need to be flexible because, like Peter Bernstein said, you never know where the next windfall is going to come from. You never know which is going to be tomorrow's performing asset class, which is why having allocation towards everything and being able to adjust that allocation, right, and not following a strict formula can actually create better outcomes. Gopi, if there are any questions from YouTube also, you can share. I'd just like to also leave our QR code here. In case you want to see more of our webinars, you can check out our YouTube channel. If you want to know more about what we do also, I think there'd be a lot of good content that's here. Okay, so we've got our second question. Which AMC mutual fund following value plus growth model, which model is helpful for wealth creation? I don't think there's any specific AMC that does this because each AMC has multiple schemes, and schemes actually have, based on the fund manager and their preference mandate, I think you have that. But there are a lot of good options if you're looking at value plus growth, and you can reach out to your mutual fund distributor if you want to talk to our team. We do a lot of product research on the mutual fund space. Then we can help you find the right scheme as well that fit your requirements. No. From an operational perspective, you may not be able to use your existing demat account for the PMS, primarily because there is a custodian involved, etc. So it will have to be opened as a separate account. But that being said, the demat account is in your name. There is no, the securities will also be in your demat account. It's not a common account in that sense. We still have a few more minutes left in our meeting. So if anyone has questions about the markets, questions about risk management, multi-asset investing, I'm happy to take anything that's on your mind. You're welcome, sir. We conduct webinars every week on multiple topics, primarily to engage with investors. So we hope to see you at another webinar very soon. I wish I knew the answer to that question. No idea when the market will bounce back. May happen next week. It may happen in some time, but we don't know. But we don't also have to wait for the market to create wealth. I think that's the basic idea, right? That we can look at ways to create wealth that are more sustainable, that are independent of what the market does. I think that is basically what we're trying to do. What are the services that you are providing to the PMS customer? Would you like to have a one-on-one session with our team? Maybe like we can, if you drop us a message on WhatsApp at 9500027285, then we can actually do a little bit more detailed and personalized call on this. But ideally, we have 5 PMS products, 2 on the multi-asset side, depending on whether you're a resident or non-resident, 1 in the flexi cap space, 1 small and mid cap, and 1 large cap. So this pretty much covers the entire universe in terms of what an investor might need. Over and above this, we also have an independent entity that does mutual fund distribution. And we also offer financial planning services to investors so that they can plan out their financial goals and work towards them with multiple products. Okay, so please explain about risk management. At ithought, our primary risk management strategy is we take a lot of cash calls in terms of when we should participate in the market. We follow an approach of value investing. This ensures that we have some downside protection and we have more upside potential, right? That means lower risk, better rewards. That's the basic idea. We're also contrarian, which means your investing journey can actually be a little different from everyone else's, more exciting as well, because you have a very different set of investment opportunities that are open to you. Thank you, sir. That's a very nice compliment that you've paid me. What is your view on gold and silver considering US election results? We are still quite positive on precious metals, primarily because regardless of who came in through the US election, inflation is still a problem at a global level, right? And because of that, you will see a shift towards precious metals. From a silver perspective, it's also an industrial metal. So if you're looking at production and availability, there is a certain level of scarcity that could come into place. So silver can become a lot more valuable from that perspective. Gold is more defensive. I think you are seeing US markets at very stretched valuations. There has to be some reversal in what is happening. So definitely, I think we are still quite positive on this. Your view between BAF and multi-asset. So I think BAF and multi-asset is kind of what I was trying to say between the 60-40 and the multi-asset portfolio, right? When you have 60-40 debt equity alone, debt and equity work together in most market contexts. But when you have a high inflation period, then both debt and equity will take a hit, right? And you need commodities in that portfolio. You need cash in that portfolio. So our preference is always for multi-asset, but yes, you can have a BAF in your portfolio if that's what you want, right? Or you can have debt and equity funds in your portfolio. It's always a good time to enroll in M2W. That's the idea behind the program. Please enroll, get started, because enrolling in the program is the first step towards your 1 crore journey, right? Once you enroll, there's so much to do and there's a lot that you can learn, and it can be quite an interesting journey for an investor. Uh, okay, so more about in terms of financial advice, we do financial planning. You can again, I think Gopi has just above your message, he's dropped a link so that you can just directly message us on WhatsApp. And you can just say that you want to schedule a one-on-one call, because I think that will be the easiest route. You can, of course, go and look at the website, but that may not answer all of your questions. It's just from an information perspective, right? So what we do in financial planning is that we help investors, first of all, set the right goals. So in terms of planning, in terms of how much you need to account for in terms of inflation, how to space out your financial goals and commitments, checking if you have enough of insurance, the right kind of insurance products, looking at your overall asset allocation and bringing that into better balance, helping you manage any of your loans. So all of this gets covered under financial planning. Over and above that, we do portfolio management. We also have mutual fund distribution as a separate entity. So if you're interested in just starting out investments, then you can either consider the PMS or mutual fund distribution. If you want some clarity before you start your investments, then definitely financial planning is the place to start. Your view on multi-asset fund versus multi-sector rotation fund. So honestly, if you ask me, a multi-sector rotation fund is essentially just a flexi cap, right? It just has it's just packaged and branded in a different way, but ideally that's what it's doing. It's saying that I have a sector, sectors keep changing, and maybe the structure is that they have more in terms of sectoral allocation. Maybe they have 5 sectors or 10 sectors in the fund, and so maybe structurally it can be slightly different. But when we look at it from this the perspective of this question, you're just asking, would I prefer a multi-asset fund or a flexi cap fund? And I think multi-asset works for more investors, primarily because many investors are not ready to deal with the downside that comes with pure equity investing, right? How many people are capable of dealing with a 30% drawdown in small cap, right? Or small and mid, even if you have some large cap protection, maybe that correction might be 20%. Many of us are not prepared, right, emotionally to deal with that level of volatility and participate when performance is so low. So when that happens, I think multi-asset tends to work better because that confidence never goes away from the investor. Whereas pure equity investing can test an investor's confidence. So it's a very personal call. If you know, or if you have the experience and you're with somebody who's able to guide you through a pure equity investing route, then I think that can also work quite well. But if you are on your own and that risk profile test exercise that I had recommended earlier, and you feel that there's some differentiation between what you're doing versus what you think you're doing, then I think maybe multi-asset can serve you better because your compounding will be more consistent. Your compounding will not be interrupted by your emotions. Okay. So next question, psychology, drive, investing, consistency, patience, and perseverance are some part of investing. 100%, sir. I think you've absolutely nailed that. Yes, this recording will be available on YouTube. Um, okay. Kindly guide us. It's the right time to invest lump sum and guide us maximum fall expected sector-wise fund allocation, please. I think you can consider enrolling for M2W if this is what you're looking for, because then you'll be part of the program. They will sort of guide you on how much to invest in terms of lump sum and which sectors are suitable for you at what point in the market cycle. But in terms of maximum fall, like neither can I do that, nor do I know any investor who will be able to tell what is the maximum fall. We can look at history, but history is only a reference point. It does not tell us anything, right, about what the future is going to be like. So it's better to just be a little bit more cautious and careful and plan our investments. That have your plan A, that okay, like if you think market is going to correct 5%, then how will you respond to that? If it corrects 10%, how will you respond to that? If it corrects 20%, 30%, 40%, we need to have a response plan for situations that may not even occur. I think then it works out okay. All right. I don't see any more questions coming in. So I would once again like to thank everyone who's been here today and participating in this conversation. I hope this was a very useful session for you. If you have more questions and you'd like to schedule a one-on-one call with our team, or you want to clarify anything that you couldn't in this space, then please do drop us a message on WhatsApp 9500027285. Gopi has also left the link for you in the chat. So that'll be very easy. You just have to click on it and it'll directly open into the WhatsApp chat. So thank you once again. Yes. Yeah, sure. Please post our last question. Given the current inflation is high due to vegetable inflation, do you think RBI will consider rate cuts given inflation in other items in the basket is not so high? So I think earlier in the presentation also we had taken something that the governor had said, where he said that a rate cut right now would be premature given that, and this was in the October meeting, right? So at that point, it was 5.2%, and now our latest reading is 6.2%. So I definitely don't think there will be any rate cut until you see some stability in inflation. Because at the end of the day, it's not just about one item in the basket, right? You need to be in that range and you need to be sustainably in that range. And that's the messaging we got from the RBI so far. So it's definitely not a follow the Fed or follow another central bank in terms of um, how that rate cut is going to happen. I think you need to have some clarity or some justification for a rate cut. So we are at a higher level of growth, so we don't need to stimulate growth. We are at a higher level of inflation and we need to bring inflation down, right? So if we look at that growth inflation dynamic alone, there is absolutely no logical reason to cut rates at this point. However, like if one of those elements changes quite a bit, uh, if there are significant risks to domestic growth because of a slowdown globally, then maybe even when inflation is high, you might see one rate cut. Or you might see the rate cut happen before inflation falls because monetary policy also acts with a lag. So you do know that there is some leeway or there are some early indicators that show you the direction in which inflation and growth are progressing. So that's the overall view. But you are right in terms of the primary contributor to that larger inflation print last month was vegetables. It's nothing else in the basket. All right. So thank you, everyone. Hope to see you at our next webinar. Gopi, can you just post the link for the 12 p.m. webinar as well? I think someone has asked for that, the direct joining link. Thank you, sir. The link for the 12 p.m. webinar is also here. So thanks once again. We'll be seeing you soon.